As at the midway point of last year, alternative assets officially surpassed $10 trillion.
Medical receivables were based on the inefficiency of the U.S. healthcare markets. The fund targets the mid-teens to low 20s return with minimal, if any, downside volatility.
There's going to be $68 trillion of wealth that's going to be transferred from the older generations to the younger generations over the next 25 years. And as this wealth gets transferred, a certain percentage of that will go into Bitcoin and other cryptocurrencies.
Currently, there are not any markets that are providing new coverages for COVID-19. A couple of years ago, when we did have the Ebola scare, Lloyd's did offer policies, but because of the unknown cost, less than 10 of these policies were sold.
The U.S. mortgage market, it's $15 trillion with approximately $4.5 trillion in commercial mortgage loans. Even a small percentage increase in non-performing loans provides billions of dollars of opportunities to extract value.
Good morning. Welcome to FLIA's Real Estate Direct Lending and Private Debt Forum, Part 9. This is the 9th in a series. We would like to thank our sponsors, Nationwide, Preqin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, the Mortgage Office, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Entrust Global, EMQQ, Robo Capital, Off the Chain Capital, Clarion Asset Management, and LinkVest Capital for making this event possible. Also, we'd like to thank our FLIA board members and FLIA members for their support during these challenging times. For those of you that are not familiar with FLIA, FLIA is a 501c6 nonprofit organization started in 2007 with the goal of becoming the world's leading marketplace for alternative investments and alternative investment education. Since then, FLIA has helped thousands of firms in the capital raising process, aided in the allocation of billions to alternative investments, and leveraged technology to accelerate the due diligence process. Today, when you look at FLIA, FLIA has over 8,000 members with over $5 trillion in discretionary AUM. We'd like to thank you for attending our event today, and we hope you enjoy the day. Our first presenter this morning is Mr. Dave Lowry, Head of Research Insights at Preqin. The topic this morning is private markets, a path out of the COVID impact. Dave?
Thanks very much, Ryan. Much appreciated. And good morning, good afternoon, everybody, depending on which time zones you're in today. Thanks for taking the time to attend today's session. I'm Dave Lowry, and I'm the Head of Research Insights at Preqin. For those of you that want them, these slides will be available after the event. So if you have any questions after taking the time to review them, either ask the questions through the Q&A box that you should be able to see as part of the presentation today, or do get in touch separately. We only have a brief amount of time for today's session, so in the interest of time, I'm going to get going. Thanks very much. For those of you who aren't familiar with Preqin, we're the leading provider of alternative assets data with global coverage across key fundraising, performance, deals, and LP and GP activity. The plan for today is to give you a private market overview and then drill down a little bit further into our 2025 AUM forecasts before then providing a summary of where we are in the market and how we might potentially see a path out of the COVID pandemic in the future. It's important to see exactly where we're coming from with a global perspective. And as you can see, assets under management across the alternative assets industry have increased significantly in recent years, reaching more than $7 trillion as at the end of March 2020. There has been a dip in AUM in the period between the end of Q4 2019 to the end of Q1 2020, but that largely reflects revaluations in Q1 when public equity markets were heavily sold off. The subsequent, and some might also say stellar, recovery is likely to mean that this dip in assets under management is only going to be temporary. Given the fund closing so far throughout 2020, it looks likely that we'll be moving towards $8 trillion as next year progresses. This strong AUM growth over time has been across the board, with all asset classes covered by Preqin experiencing huge AUM growth in recent years. Private equity was and remains the single largest asset class, accounting for almost half of AUM. Turning now to dry powder, the data that we have for dry powder is a little more recent, and at almost $2.5 trillion, dry powder is also at record levels. It's worth pointing out that prior to COVID-19, many investors were highlighting that valuations were at elevated levels, with many asset classes fully valued. This is reflected in the ongoing frequent investor surveys that we publish around 2 to 3 times every year in our standalone reports and also in our global annual reports. What we didn't expect was that the correction which brought the previous cycle to an end would be a global pandemic of the scale that we've witnessed in recent times. The hit to both the supply side and the demand side has been unprecedented. While we shouldn't ignore the human impact of the pandemic, which has been huge, the private capital market has also been impacted, with reduced activity across all asset classes throughout 2020. Having such large-scale firepower available puts fund managers in a strong position to react when favoured assets do become available, regardless of the size of the asset in question. That said, competition for the best quality assets can be fierce, meaning that valuations may not be as heavily impacted as they might have been if this wall of capital wasn't available. One of the main drivers of AUM and dry powder growth has been the significant levels of fundraising in recent years. In fact, 2019 was the third consecutive year of fundraising hitting more than $1 trillion. While fundraising has been exceptionally strong, this capital is increasingly concentrated in a smaller number of funds as they increase in size. Understandably, we've seen a hit to fundraising this year overall, but there have still been several large-scale vehicles raised. It's unlikely that we'll hit the heavy heights of $1 trillion again, but if we see several large-scale funds close in the final month of the year, or now in the final weeks of the year, it's not totally out of the question that we might get relatively close to it. It's a long shot, but it's potentially doable with a fair wind. If you'd have mentioned that fundraising would potentially be on a par with where it was over the past few years at the start of 2020, I think everybody would have been very, very happy with that outcome. Looking at fundraising now on a month-by-month basis, there have been many ups and downs. Obviously, the COVID impact was mainly experienced at the start of Q2, but it's remained volatile ever since. And this is looking at overall private capital market fundraising. As the second wave emerged in Europe and subsequently spread to the US, the fundraising market took another hit towards the back end of summer, so July, August time, but then saw a subsequent sharp increase in October. December will be interesting, as there was a solid start, but it's unlikely to shoot the lights out. Private equity funds in market are at record levels, with more than 4,000 funds on the road, figuratively at least, during 2020. Despite the record number of funds in market, they're seeking a slightly lower amount of aggregate capital than they were at the start of the year. That could be due to some large-scale funds already closing, or it could be that managers are seeking to raise smaller funds so they can close them sooner and begin to deploy capital into a market which they might feel is increasingly attractive. In a similar trend to private equity fundraising, private debt is experiencing record levels of activity. The number of funds in market is at record levels, more than 500 of them, and they're collectively seeking almost $300 billion, up almost 50% compared to the start of the year. Low yields available from other asset classes are driving this activity, with fund managers responding to investor needs for secure income at levels over and above that offered by treasuries, for example. It's unlikely that with this dynamic just potentially there to set in stone for at least the next few years, that we'll see reduced levels of interest among investors for private debt, despite what happens on the deal side. Looking now at real estate, despite the hit to real estate fundraising activity in 2020, it's not deterring fund managers from trying to raise additional capital. Funds in market are at record levels in December, with more than 1,000 in market at the moment. And these funds are also seeking record levels of capital, also greater than $300 billion. Looking now at deals, there's been some volatility, but deal volumes have been on a gradual downward path since 2018, with some peaks and troughs along the way. This is likely to reflect the fact that towards the end of the previous cycle, valuations were at levels that some investors just simply weren't comfortable paying. As we progressed into 2020, the Q1 hit to valuations might have otherwise spurred an increase in activity, but restricted travel and the difficulty in performing online due diligence made disposals and acquisitions more lengthy and difficult to execute. This is likely one of the reasons deal volumes have been hit so hard throughout this year. Looking more closely at the number of private equity deals during 2020, there's been a hit almost across the board, on top of that already experienced during 2019. There were declines across all sectors, but IT deals stand out particularly, along with finance and insurance services. These were the best protected sectors thus far into 2020, and for IT particularly, it's easy to see why with public market valuations where they are. Quite surprisingly, the total value of buyout deals in 2020 isn't too far behind that of 2019. Strong numbers given the backdrop. Finance and insurance services again stands out here, with E-Trade the largest deal by value at $14 billion. Another deal that stands out is the KKR acquisition of Global Atlantic, the insurance firm, which is particularly interesting. There's an increasing trend among some fund managers to acquire insurance firms as they search for permanent capital to manage, and this is just one example of that in action. Private debt deals have also suffered throughout 2020 in a continuation of the trend, which kicked off during 2019. As with other asset classes, the deal numbers peaked during 2018 and then began falling. Again, this could be due to the late cycle effects, where investors were responding to Preqin surveys suggested that high valuations were among the biggest barriers to deal activity and return generation over the coming 12 months. Consumer discretionary has been among the hardest hit sectors, which is unlikely to come as a surprise given the COVID impact has hit this part of the economy particularly hard. While the number of private debt deals has declined, the value of those deals has also fallen even further when compared to the 2018 peak. Nowhere is this more obvious than the consumer discretionary sector, which accounted for $24 billion worth of deals in 2019 and fell to $6.1 billion in 2020. As a comparison, during 2018, consumer discretionary deals reached $48 billion. At the other end of the scale, industrials have experienced a bumper year with several large-scale debt finance deals. Looking at the real estate deal numbers, retail and offices stand out as the hardest hit. That's probably unsurprising given that these two asset classes tend to be the largest from an institutional investor perspective and are both subject to significant uncertainty around occupier demand. Retail sector valuations have repriced in recent years, even before COVID accelerated previous trends, which has hit both in-store transaction activity and footfall. With more home working expected in the future, office demand could reduce despite the push from less office space and despite the push from less office time and the pull for more space being required per employee when they are in the office. Look out for deeper analysis of these trends early next year when Preqin releases its global annual report for the real estate asset class. In a similar pattern to deal numbers, values have also been hit across the board. Industrial is often mentioned as the most attractive sector from a demand perspective from investors and fund managers, but repricing might make it difficult for those investors not already exposed to the sector to enter in a meaningful way. Build-to-suit's one potentially attractive entry point, while large-scale portfolio deals are another, and we saw one of those announced this morning with AXA Investment Managers acquiring a portfolio of assets in the US for just under $1 billion. Turning now to our future outlook, Preqin recently released its Future of Alternatives digital campaign, which alongside its investor survey also included a prediction as to future global private market assets under management. These forecasts point to annual growth not far off 10%, with AUM breaching $17 trillion in 2025, up from almost $11 trillion at the end of 2020, and this includes hedge funds. The forecasts are the result of internal collaboration between the Research Insights team and our own internal data science experts as we look to leverage our internal expertise. Regional growth will not be evenly spread, with APAC expected to benefit from the strongest growth. The US will still be the dominant region, however, but APAC will overtake Europe and then extend that gap quite significantly. Looking at the absolute growth numbers, APAC growth will hit around 207%, whereas the US and Europe should each grow by around 30% in total over the next 5 years. Again, turning to the individual regions here, you can see a perfectly even growth across the US and Europe at 5.4%, compared to 11.1% in Latin America and 25.2% for Asia Pacific markets. One of the reasons behind the faster growth in APAC is the fact that this market is much less mature than many other markets around the world. And there's a significant amount of activity being drawn to that market. It's almost creating its own center of gravity, and it's increasing in size from a relatively low base, particularly given the size of some of these economies that you have in the Asia Pacific markets, such as China, Japan, and South Korea. Looking more closely at our private equity AUM forecast, we're expecting growth there of more than 15% over the next 5 years. One of the drivers of private market activity and investor interest is the fact that we've got such low yields available from other asset classes, and many investors view equity valuations as stretched. That's why we're seeing increased allocations towards alternatives at present, and many expect this to increase in the future. There was a recent interesting comment from Brookfield Asset Management, which suggested that the kind of previous 60-40 equity to other asset class split among institutional portfolios could be flipped on its head, with potentially up to 60% allocations to alternatives, given either the low returns or the high valuations across other asset classes. If that happens, then our overall AUM forecasts will prove to be incredibly conservative. Turning specifically to private debt, this is our second strongest sector, according to our predictions here, with growth of more than 11% per year. And again, the low yields available from other forms of debt are really what's driving this demand for the sector among investors. We don't expect that to slow down anytime soon, although there is a threat of inflation rearing its ugly head at some point in the near future. So that's a trend that we'll be watching very, very closely, particularly in the US. Real estate AUM growth is relatively lackluster by comparison, with the sector likely to be held back by demand uncertainty across the retail and the office sector. Although these are kind of forecasts of 3.4% growth, it's likely that we might see lower growth than that in the most immediate years, so 2021 and 2022. And then as the economy rebounds and there's a bit more of a clear path out of COVID in terms of how offices will work, what retail demand might look like, and how the retail sector is adjusting to the shifts caused by COVID with the acceleration in online sales, it might mean that we see a stronger bounce back in the later years for the real estate sector. Looking at unlisted infrastructure assets under management, we expect growth there of around 4.5% per year. Well, one of the key aspects for the growth within this market is the fact that governments around the world have pumped trillions of dollars of liquidity into their markets as they try to protect their economies, often with no real regard to fiscal positions. As that becomes an increased focus in the next few years, it's likely that they will turn to private markets to try fund infrastructure growth and try rebuild some economies and to invest in their infrastructure, which often has a really good multiplier effect for the economy. Private markets are expected to play a really vital role in the delivery of those infrastructure assets and growth within that sector. One of the risks around that is the increasing difficulty or the ongoing difficulty in pricing construction risks for those who aren't really experienced in that. So that's something that the government is likely to potentially step in and offer some kind of support or a financial backstop. And if they're able to do that, whether it's from the introduction of feed-in tariffs or contracts for difference for energy projects, it's likely that we'll see much more of these or a greater prevalence of these in the future. Turning to natural resources, we're expecting growth of just over 5% per year. And it would be fair to say that one of the key drivers of this is potentially the weaker dollar that we're going to see, but also a switch to renewable energy as well. So renewable energy projects are captured within this. There's also an significantly increased investor interest in things like agriculture or ag tech, as well as timberland, which are seen as potentially great ways to boost a firm's ESG metrics, particularly when it comes to carbon sequestration. Hedge fund AUM growth is likely to be pretty lackluster. We've seen lots of ups and downs across this sector, across this asset class in recent years, with solid performance often offset by fund outflows. So it'll be really interesting to see exactly how this sector pans out in recent years. In terms of the strategies targeted by investors for hedge funds over the next 12 months. Long-short equity is the most popular, followed by macro and multi-strategy. When we actually look at investor preferences by region, it's interesting to see that there's a potentially declining interest in North America and Europe, and a greater increase in interest across Asia Pacific, rest of the world, which includes Australia and emerging markets. It's likely that a potentially weaker dollar has some impact on this, but also valuations in developed markets are appearing relatively stretched, which is what's pushing many investors into new markets as they seek to drive higher returns in the future. Looking at fund managers' views on risks and opportunities, it's really interesting to see that politics, regulation, and the wider political landscape, and a result of that as well, barriers to trade, are all seen as potential blockers to returns over the next 5 years, or potentially impacting businesses over the next 5 years. I'd say that certainly in recent years, politics has come to the fore as a potential risk, and so it'll be really interesting to see how that plays out over the next few years, particularly in the US. And I would say that there's a lot riding on the Senate runoff in January in Georgia, just to see exactly how the Senate will be composed and exactly what that will look like, and whether that will allow a Biden administration to pursue their ambitious plans, or whether that will be kept in check. So some really interesting things to look out for on that front over the next few years. What I also wanted to do in this presentation here is also kind of talk a little bit about the rise of ESG in alternative assets. It's one of the things that our fund manager clients and our LP clients ask us about quite a lot. We've invested quite a lot of time at Preqin in expanding our ESG data set, launching transparency indicators across many of our data points as well. And it's something that we'll be building out in future months and years as well. Looking at ESG-focused funds, they've accounted for a growing proportion of capital raising in recent years, as more investors demand ESG-related focus or compliance, rather than simply what was previously a box-ticking exercise. Nuances in the data explain the large bounce of 2013, and history details going back here to 2011, but represent a wider ESG trend overall. One of the things we're often asked about among our investors is, if I invest in an ESG fund or an impact fund, do I take a performance hit? Excuse me. As you can see from the chart here, the answer to that is definitely not. ESG and impact funds generally do not suffer in terms of performance in their pursuit of their broader goals. The blue and the grey markers on this chart show ESG and impact funds' median net IRRs and standard deviation across vintages. Not only are returns solid, there's also less dispersion among these returns across vintages. So it's a win-win situation for ESG and impact fund investors. Excuse me. So now to summarize, a key trend we've seen in recent years is that even though more capital is raised annually, it's going into the hands of fewer GPs. 2020 and the challenges it posed investors could mean we see a continued flight to the biggest asset managers. This may mean for smaller, new and emerging managers, it will be difficult to gain traction, which is a real shame, as this is often where new and exciting innovations happen within markets, and these really innovative new products often help LPs. This might be a short-term thing with the onset of COVID and the difficulty in forming relationships with new managers, but it was a trend that was already evident prior to COVID, and it's just seen an acceleration throughout 2020. The response to this crisis has been very different to the GFC. The investors that we've been speaking to have been praising managers for being available, explaining exposures and answering detailed questions relatively quickly. Turning back time to 2008 was pretty much the opposite. And fundamentally, the alternatives landscape is bigger, much more institutional and more robust, with secure infrastructure and systems in place. I think these changes enable managers to adapt quickly, and this is very reassuring to investors. It's some of these points which are also acting to attract more investors to the asset class. Alternative assets have their part to play in helping the world recover from the devastating human and economic fallout of the pandemic, both through how GPs have worked with their portfolio companies and assets to, for example, reduce rents, defer interest payments, and in general guiding their portfolio companies through the crisis. But also as well as investors investing in new technologies and medicines and what have you, that might be key to getting the world back on its feet and to some semblance of normality in 2021. So overall, although COVID-19 has clearly had an impact during 2020, we do think that the alternatives industry will not only weather this impact, but will then thrive afterwards. The true impact of COVID might be one of more change and growth in the alternative space. The reason the industry has shown so much growth has been that the alternative fund managers have been adapting rapidly and evolving to changing environments. 2021 is likely to provide a path out of COVID, but the world will move at different speeds and be pushed and pulled in different directions due to politics and logistics. Nothing's going to happen in a linear way, and there will definitely be lots of ups and downs throughout the next 12 months. But still, given the wall of capital on the sidelines and the sharp recovery in public equity markets, valuations may not fall as far as some had initially expected in Q1 of this year. As a result, 2020 might not be the strong performing recessionary vintages that many thought would be the case at the start of the year. But with returns from other asset classes low, or in some cases negative, there will still be increased demand for alternative assets. It's this which is driving our AUM growth expectations over the next 5 years. So that concludes my presentation for today. Thanks very much for taking the time to listen. I'm happy to answer any questions that you might have. Thank you very much indeed.
So Dave, we have some questions here. What's the outlook for returns across the main asset classes during 2021?
To be frank, I would say that the potential for returns are still relatively solid compared to those that we've seen, and certainly towards the end of the last cycle. Excuse me. We did see a slight reduction in performance across later vintages, so 16, 17, and 18. And it's likely that as when we start to see vintages of 2018 and 2019 reporting, they might be kind of a little bit lower, but still likely to be in double digits, probably across the board for many of the asset classes. We did see a hit to valuations in the first quarter of this year, but then we were kind of informed by many clients that in terms of valuations, there was almost a trend to throw the baby out with the bathwater and mark down relatively aggressively in Q1. So we're expecting a relatively strong bounce back in Q2 and then throughout the rest of 2020. I think given the scale and the speed of the government interventions that we saw with direct checks to individuals in the US, bailing out of many sectors, job retention and furlough schemes elsewhere in the world, that really did cushion the impact outside of the broader economic headline numbers. So I think valuations and returns will be supported in future years.
Okay. Another question that's coming in. Hang on one second. Some people want the slides. Is it okay to send them the slides after?
Yeah, absolutely. I think we'll be providing a link to all of the slides and they'll be available via our website. So we'll be sending that around to all participants after the event, as far as I'm aware.
All right. So we have a question here from Vincent Catalano. How much of the AUM growth is due to institutional investors in their need to meet their required returns that they cannot achieve from public markets?
I'd say a significant proportion, to be completely honest with you. With lower returns available elsewhere, we're seeing increased interest from new investors into alternatives, but we're also seeing greater allocations for those already experienced and with often large-scale allocations to alternatives already. As I mentioned in the presentation, there was a recent stat that came out from Brookfield Asset Management, where they say that allocations to alternatives could potentially increase from the 25% level around where they are at the moment, potentially increasing towards 60% by 2030. If that happens, it will be a huge game changer for the industry, and it will mean that our AUM forecasts are way too conservative, because the number in terms of AUM for the sector, if that were to happen, would be much higher than that 17 trillion that we've already got baked in.
Got you. Okay. Vinny, hopefully that answers your question. How do you see the various asset classes evolving throughout 2021 compared to 2020?
Yeah, it's an interesting question. If you look at things like the private debt sector or the private debt asset class, we've got lots of investor interest, But we also do have some concerns around how much money is being attracted to that sector and how quickly those funding market and the amount of capital that they're targeting is growing. So I think that there'll be lots of competition for deals. So that's going to be potentially one thing that will act as a bit of a barrier to really strong returns. So I think that's something to be watchful of. In the buyout space, it's likely that we're still going to have really good access to cheap credit, which can fuel some buyout deals. There are potentially still lots more that can be done. It might mean, given public equity valuations, that we see more IPOs rather than sales to other GPs. So that's something to watch out for, particularly in the VC sector as well, where we saw a really big spike in the number of IPOs in Q3 of this year. If you look at small cap valuations, which are increasing quite strongly as well, I think that's going to be something that we'll be watching relatively closely as a bit of a barometer for activity in the VC space. To turn into that part of the market on a global basis as well, we're seeing lots of investor interest in early stage startups and investments across Asia Pacific, particularly in China, also in Australia as well, and in Japan. So that's something that we've kind of found particularly interesting to look out for throughout this year, and it's something that we'll be watching in more detail next year. In terms of the other asset classes, for real estate, the outlook there is actually relatively mixed. As I alluded to in the presentation, we have lots of investor interest in industrial and logistics assets, but we have had that for several years. It's just been accelerated again by COVID. But we've seen some really strong repricing in recent years across those assets. Something that might have traded in the past for 6.5% is probably trading close to 4% or 4.5% these days. So it makes it quite difficult to kind of see exactly where the upside comes from in that part of the market particularly, which is why one of the things that we're kind of talking about increasingly is the increased attractiveness of build-to-suits. So if you can develop a logistics asset for someone who you can then sign a 15-year lease with, if they've got a strong covenant, then that's a really good way to drive returns. And with a development like that, you can either get a good yield on cost upon completion, or you can then go and flip it at the end of that construction phase and realize a good return. So there are plenty of opportunities out there for real estate. And quite conversely, one of the things that we're kind of mentioning as well for the office sector is that development might actually be increasingly attractive for office assets, because it could be very expensive to reposition existing offices to benefit from the new ways of working, which means increased flexibility, more meetings and breakout and collaboration space and things like that. So if you can bake these into development upfront, you'll be a much more attractive building from an occupier perspective.
So I'm going to jump in and out of various questions. There's another question coming in. It says, can you give us your thoughts on SPACs? And then drilling down a little bit deeper into that same topic as it relates to private capital and a backdoor to going public.
Yeah, it's a very interesting one. And one of our senior writers tackled the subject relatively recently. So if you have access to our website, certainly have a look through it for his article, which is really interesting. One of the things that he did was try to put SPACs in perspective, because they've been generating lots of headlines and column inches in recent months. But if you actually look at the amount raised in SPACs, it might be, off the top of my head, less than 100 billion, probably a little bit more than that now. But if you compare that to dry powder in the buyout space, which is more than $1 trillion, off the top of my head, then it kind of puts that into perspective. So they are competing with the likes of buyout funds and what have you, where there's lots of capital on the sidelines. So I think they're great for generating headlines. I want to see a little bit more activity among them at the moment, just to see exactly what type of returns they can deliver long term, because the buyout market it has been around for a long time. It's tried and tested. The returns are there. They're clear for everybody to see. So I think SPACs have still got a lot of proving of themselves to do yet.
Okay. So another gentleman by the name of Mark Howard is asking, regarding your 2025 sector growth forecast, is the assumption straight line economic growth during those years, or is there a recession considered during this time period?
It's a really good question, actually. And when we were putting these forecasts together, what we tried to do is bake in the 2020 impact into those numbers. So we're putting them together in October. So we were looking at annualized numbers for our AUM, our deals, and our fundraising. So we kind of put lots of frequent data into our model. And so we already have the impact of 2020 within that. It'd be fair to say that we're not expecting another recession in the next 5 years over and above the economic impact that we've seen for this year as well. So the way the models are run, it's actually a series of models with various data points looking at, say, for example, macroeconomic data and seeing where the statistical relationships are strongest when it comes to fundraising, deal activity, AUM, unrealized value, and capital raising and what have you. So we have a huge series of models there which run individually and then produce the numbers at the end. So we have our long-term trend, which also kind of factors in recessions kind of post 2000, as well as the 2007, 2008 financial crisis. And then for Europe, we've also got the impact of the European sovereign debt crisis there in 11-12. So we have all of that baked in terms of our forecasts and the various inputs. So that is reflected into it. But we don't explicitly have another recession between 2021 and 25 within those numbers. The model is actually relatively conservative. We kind of did some back solving to say exactly what's implied by those numbers, and essentially it's fundraising at less than half the levels that we've seen in recent years, and returns at less than half the level that we've seen in recent years as well. So if anything, there's probably a significant upside to those forecasts. The idea was that we just be relatively conservative at this stage, given the kind of risks within markets at the moment. So I hope that helps explain it.
Yeah, absolutely. So yesterday there was something out of Preqin Spotlight talking about private debt managers steering away from the distressed label. Can you give us some insights into distressed and where this is heading?
Yeah, it's an interesting one, because if you'd have asked me at the end of Q1 what the outlook for distressed was, my answer would probably be very different to my answer now. And I think a lot of GPs saw the LP's expectation for significant repricing and lots of opportunity within that distressed space. And this is across all asset classes as well. But the government interventions that we've seen have probably kind of cushioned that to a certain extent. So while there's been some distress in some sectors, and you can probably point to anything hospitality related or consumer facing on the retail side in recent months, other parts of the economy have actually been relatively well protected. So although there's lots of money chasing these distressed assets, there are probably fewer of them around now than many people were expecting at the start of the year. And I don't think that's really going to change into 2021 either, unless we have a second wave of impacts when the government stimulus and the support packages start to roll off. But this is where governments around the world are going to be treading very, very carefully in the future. They're going to know all these risks, they'll be aware of them, and they'll be trying to manage them as closely as possible. We just had an announcement an hour or so ago in the UK that the furlough job retention scheme has been extended by another month to the end of April. And so I think governments will keep tweaking things like that to try and alleviate some of the pressure on companies, which will reduce those number of distressed opportunities.
How much money has been raised, or is it too soon to actually know how much has been raised after Q1 into distressed assets?
We do have the data. I haven't got it to hand right now. So what I would say there, I can certainly follow up offline with those numbers if it would help.
Okay, perfect. Getting deeper into the questions here, are there any major trends evident either across specific asset classes or alternative markets generally?
Yeah, so we're tracking a few of these, what we've described there as mega trends. And one of those is something I touched on earlier in the presentation. So that is the capital consolidation. So consolidation into bigger funds and with the largest managers. That's something that was evident before COVID and has been exacerbated because of COVID as well. It's been a really tough market for emerging or new or first-time fund managers across all asset classes and across most regions, I would say, potentially with APAC, there's a slight exception there. But that's something that we're kind of seeing across the board, and it's something that we expect to continue. Another thing is the rise of ESG, so I touched on in the presentation there. there's a real increasing demand for ESG-focused funds. LPs are really getting into the weeds with the managers that they're looking to allocate cash to see what are their ESG policies, both stated and actually in reality, so they can actually see the fruits of their ESG labour. There's a huge amount of focus on that as well. We're also kind of expecting potentially some of these big funds to start doing more mega deals, so what we would describe as $1 billion plus. We're expecting many more of those, and we're already kind of seeing some of these in the private debt space as well. Actually, in the kind of transportation sector, which has been quite interesting. So we're expecting more of that as well. So these are kind of a couple of our key underlying trends that we're following over the next few years.
Okay. So this gets into a little bit of the differences in the regions. And this is a very interesting question. Your forecast growth in AUM points towards strong growth in APAC. What's driving that? And then what's driving the underperformance in, say, Europe, as you highlighted in your presentation, and what's driving the growth in the US as well?
Yeah, and to be completely honest, it's more around market maturity. So we're expecting US and European growth to be solid, but not stellar at the moment. And this kind of comes back to our forecast being relatively conservative, excuse me, as well. So we didn't want to go with a really big number first. We want to put our forecasts out there, test them to a certain extent, see what happens over the next 6 to 12 months, and then we'll revisit our forecasts once or twice every year just to see exactly how they might shift and see what the changes are. But it's definitely fair to say that US and European markets are much more mature than they are in APAC. Given that level of maturity, the potential for driving returns there is probably a bit less than it is in other jurisdictions. We're seeing among our investors that there's much more interest among Asia Pacific, and a lot of that interest is focused on China and ASEAN markets, so the Association of Southeast Asian Nations. So they're really in demand, but also across countries like Japan, which are relatively nascent in their PE and their VC sectors from an international perspective anyway. And it's the kind of growth from a low base that's driving that 25+% annual growth across APAC markets.
Gotcha. Okay.
In some of our investor surveys as well, we've had lots of comments from investors saying that they might start to look to take increasing risks and enter some of these more emerging markets, for want of a better description, in order to drive their returns higher. Because if they can't get the returns they need from more developed markets or certain asset classes, then their return requirements aren't necessarily shifting along with actual returns from the assets. So it means that they're kind of being spread and kind of casting their net that little bit wider.
So what is the frequent forecast for when capital raising for private funds will really pick up again?
To be honest, it hasn't actually done too bad this year, considering all of the various threats and all the headwinds that the sector's faced, really. If we can come out with a relatively straightforward exit from COVID next year, and a lot depends on logistics and rollout of vaccines and who's able to get it and whether traveling will start to a certain extent. So I think we could potentially see a decent increase next year. If we could potentially bouncing back towards that $1 trillion level again for capital raising. I wouldn't be surprised if that is the case, given certainly the interest that we're seeing from our LP clients in terms of increasing their allocations to alternatives. So I think 2020 on the fundraising side might prove to be a bit of a hiatus rather than the start of a long-term trend to go even lower. What will be interesting is how these emerging and first-time managers react to potential shifts in travel activity for next year. It could be the case that where previously a GP or an LP might have sent 5 or 10 people on a business trip to go see a manager or to go see an asset that they're looking at acquiring, they might do a lot of that early due diligence and relationship building online, and then only start to do the in-person meetings later in the year after those first hurdles have already been overcome. So I think that's going to be an interesting thing to see play out next year. I'm certainly looking forward to having the vaccine myself at some stage. I don't know about you guys.
Oh, absolutely. So the later part of the year is basically when you believe the fundraising will pick up. Are there any specific insights? Is anything in particular that you guys watch in order to keep your finger on the pulse of of maybe a little bit more risk on appetite in private in the private space?
Yes, yeah. So across my team, although it's a relatively new team within Preqin, I joined back in June of this year. We have some top quality people with lots of industry experience across GPs and LPs. So between the group of us, we've sat on investment committees, asset allocation committees, been responsible for mandates outside of our geographies and covered various asset classes. So we're really aware of the various interplay between asset classes and markets themselves more generally. Excuse me. So one of the things that we're looking out for at the moment, just to see what kind of threats might be there to alternative investments, we're looking at things like the potential for higher inflation in the US and what that might mean, looking at the politics that might drive the inflation higher there as well, and then kind of trying to think about what impacts across certain asset classes that might lead to. So you could see the kind of potential higher inflation on real estate returns or real estate pricing, or infrastructure pricing as well, and things like that, or the potential for increased leverage or lower leverage in buyout transactions, so the need for a greater proportion of equity over debt. So we try to look at how these various things are interlinked. And across my team, we meet every 2 weeks to go through all of these things in a quite detailed manner, just so we're completely aware of exactly how public markets are tracking. And we also bring in our own Preqin data as well, which is it's a live database. It's not something that we update once and it's static for a while. We're constantly bringing in new data points. We're constantly trying to expand our data set with new managers. We've got performance data within that, fundraising, dry powder, deal activity. So we try to take as much of that on board as possible when we're trying to form our conclusions and kind of guide what might be happening across the various asset classes that we cover. And one of the big shifts that we've been doing in recent months is to try to be much more forward-looking in our work. So hence our future of alternatives forecasts. And we're trying to bring in this type of commentary much more into our Preqin content, so it'll be much more useful for the end user.
Got you. So there's a question: separate accounts versus commingled funds. What's the profile? What is the profile of separate account investors today? And Angelo, thank you for the question.
Yeah, it's a very good question, because we are actually kind of seeing an increased appetite for separate accounts or kind of club deals as well, to a certain extent, because as LPs get a bit more experience, they're prepared to actually take greater risks, and they want to work more closely with their GPs that they're working with. So we're seeing increased appetite for those types of transaction structures. And I think that's probably something that we'll be seeing increasingly in the future as well. It's a trend that won't be going away anytime soon.
Okay. So we have a question from the real estate front. Does Preqin have any new construction data, for like development? Do you guys do anything in the development space?
No, to be honest with you, it's not a data point that we actually track internally. Certainly from my experience from working in real estate and infrastructure in the past, many of the brokers kind of track those developments, excuse me, particularly well, or other organizations. So it's probably best to source that type of data from them, because it's interesting, because you can look at, say, for example, vacancy rates in construction, but I think where assets are being built is going to be increasingly important as well. One of the things that we're seeing across many of the people that we speak to, and in other people's research, to be completely honest as well, is that people, when they're going to the office, regardless of whether we have this pass out of code with the vaccine or not, they want to minimize their interactions with various pieces of public transport. If they can get on one train and then go into a hub, and if an office is located next to that hub, then that's potentially going to be in much higher demand than something that's maybe a 20-minute walk away or an additional train ride away. So that's some of the things that we're seeing. So overall development stats, I think, will be very interesting. But as with most things, you've got to really drill down into the detail and probably get down to a sub-market level construction to really see what's going on and understand the market like that.
I got you. So we are out of questions and just about out of time. Do you have any concluding remarks that you would like to make, that you would like to go into, Dave?
Yeah, I suppose my kind of final remarks, following on from my summary earlier, would be that 2020 has been a challenging year, but it's one that's been overcome by market participants across all asset classes. And I think that's something that the industry itself should be really proud of and really kind of shouting from the rooftops about, to be honest with you. Although the crisis this time has been very different to the financial crisis previously, it has been very, very tough. It's been very tough for some industries more than others. Yet companies are emerging still relatively strong. There's been lots of government support around that, but I think that the industry learnt a lot from previous events and from previous tests, and it's kind of standing the test of time. And I think it's constantly evolving to the needs of investors as well. And so it truly is. It might sound a bit corny, but it's an industry that's got something for everyone. It's weathered the storm well, and I think it will go from strength to strength over the next few years too.
Dave, thank you very much for your presentation today. It was excellent, very insightful, very timely. I wish you and your family a happy holiday. We
Likewise.
appreciate Preqin for their continued sponsorship and involvement in this series. You guys have been there with us the whole way this year, and we really do appreciate that very, very, very much. And we hope to have you back on next year. We're going to do this forum each month, starting in January 21st, for 6 months straight. So we'd love to have you back. Thank you very much for your contribution today.
My pleasure. Thanks so much indeed. And thanks to everybody else for listening as well. Happy holidays, guys.